Welcome back. Now, this is probably going to be the most important market story in coming months. Have you seen the turmoil recently in the U.S. Treasury bond market? Bond yields are rocketing to their highest level since the collapse of Lehman Brothers, leaving traders stunned and investors rattled. Is the Federal Reserve's purchases of U.S. debt partly to blame? I am joined by Frances Newton of Frances Insights. Now, Frances, you're going to want to listen to Frances. She predicted the October 2007 market crash months ahead of time, also predicted 6 months ahead of time the March 2009 market plunge, did that within 220 points. Frances, so good to be with you tonight.
Thank you, Liz. Good to be with you.
What do you think of what's going on right now in the bond markets? Are we seeing the dreaded bond market crack up we have been fearing about for months?
Yes, absolutely. The bond market, like any other market, is anticipatory. And what the bond markets are telling us now is they're preparing for one of three things. Either they're afraid that the government is not going to continue buying bonds, which means that the demand is going to falter. They're afraid of inflation, or more likely the story, they're afraid of further devaluation in the dollar. And the problem is that if we have further devaluation in the U.S. dollar, the assets denominated in U.S. dollars, the yields will go up, they'll be more expensive, and it will affect the demand on that end.
What does it mean for the regular? But what does it mean for the regular viewer and the folks out there?
For the regular folks, here's the situation. I think a lot of people, when they became uncertain about the equities, and we know that there's a lot of uncertainty out there because of the record low volumes, went in and they bought U.S. Treasuries because that's old faithful. And they went in and they didn't mind that they were paying a higher price, maybe $1.25 or $1.30 on the U.S. 30-year with a very low yield, because it was about preservation of capital, and maybe somebody would follow their advice and they'd get a little bit of a jump. The problem is that there's a lot of confidence lost in buying U.S. debt because of our debt-to-cash ratio has been so exorbitant. And the thing is that people just started selling when they lost the confidence, and then the moms and pops who got their fixed income rate said, wait a second, we're never going to be able to replace the loss in capital with this low yield. And so they stole and sold.
Right, and Frances, loan rates could go up too if this continues, because loan rates are often pegged to the bond, the 10-year yield. But I got to tell you something. When do you think government is going to understand that bonds are systemic risks? We didn't have a sovereign equity crisis. We had a sovereign debt crisis. We also have, you saw it in Asia with the currency crisis over there and the debt issuances over there in Mexico, in Thailand, on and on and on. Again, you see it being a bond crisis. Now you have the Federal Reserve monetizing the debt. I got to remind people too that, listen, Zimbabwe has a central bank as well. Frances, what do you make of all this in that scenario?
Well, I think you're absolutely spot on, Liz, because I think that we will have a risk for deflation. I think the Fed has to wake up, and I think this administration has to wake up and say, look, it's not about being right about this tax cut or that tax cut or who held whom hostage. I mean, this is child's play. Get a calculator out. Realize the fact that if we don't keep liquidity in our market, and we don't do that by buying more bonds, we do risk a default situation. The Fed has to create some kind of incentives in the short term to buy bonds, or they have to continue buying bonds themselves. But I also say that we will get a W-shape recession or possibly a depression if they don't change how they monetize the debt. I would say 2012, 2013,
Yikes.
We're really going to start to feel the pain.
I'll tell you something. Frances, the other thing, you and I were talking the other day, and this is so important. People need to realize that the velocity and the speed with which bubbles are being created around the world certainly picked up since World War II. We had, what, six or seven panics, so-called panics, economic panics in the 19th century, 15 crises since World War II alone. I'm not saying all of them can be blamed on the Federal Reserve, but what do you make of the Federal Reserve's role in all of this?
Well, if you go back to original cause, and that's the thing is I think most people aren't pulling back the carpet quite far enough. They can go back to the Federal Reserve, and it's not to make the Federal Reserve victims or anything like that. It's just to say that the algorithm that is currently in place creates boom and bust cycles. And so, the Tea Party has come out and they say, let's abolish the Fed, but let's be very careful here. Let's not get too excited. What is it about the Fed that we don't like? If you trade one bad girlfriend in for another just because she's brunette and you get the same outcome, it doesn't work. The real solution lies in...
Some people say markets could set the interest rates, or else if we don't fix the situation now, hey, the bond vigilantes are already saying, look, we're taking notice of this, China being the biggest one. But some people say if you abolish the Fed that the markets could actually set interest rates. What do you make of that argument?
Well, that argument is very, very phenomenal in theory. I'd be very interested to see how it plays in practice because there are so many variables involved. The problem is that the banking system would get completely out of control if they didn't have a central bank regulating them. But the real solution to the problem, as far as I can see, and it's about asking the right questions, is what would happen if the U.S. monetized some currency without a debt obligation to build some production, some manufacturing, and some infrastructure, something that we had to show for at the end of it. Because at the end of the day, if they don't want our goods and services, Liz, we don't have anything else to offer them.
All right.
That's a concern.
Thank you, Frances. So good to be with you tonight. Thank you so much for your time. Really appreciate it.
Thank you, Liz. My pleasure.
Next up, if you're fired up about this or any of the issues on the program, just drop us an email to